I'm Lawrence Wright from George Mason University. I've been asked to talk about stable coins and central bank digital currency, not about Bitcoin, curiously enough. Uh, but let's recap where we are in the stablecoin market. As of yesterday, these are the top five stablecoins. Tether and USDC are, of course, the best known. But there's a long list that goes beyond these five. Here's a chart showing this total stablecoin supply, and they've really only become a phenomenon since about 2020. You can see the supply rising rapidly. There's a little cliff here where US Terra collapses, and it's been fairly flat since then. So they've risen from very little to, more than $100 billion worth of value in the dozen stable coins listed here. If you want to sort of track the individual stable coins, so the total market cap is $130 billion. And as of yesterday, it was 62% Tether, USDC number two, and then Binance US dollar has shrunk quite a bit in recent weeks. And number four is DAI, which is unusual in the way it's governed. So Tether and USDC and Binance and True USD are all backed by fiat assets. So the issuing firm holds liquid, hopefully, US dollar assets equal to 100% or more of its liabilities. So liabilities in the sense that it's ready to buy back and to make a market in its stablecoin in order to keep the price at $1, or plus or minus a thousandth of a cent. So it issues and buys back units as necessary. USDC, as the previous chart showed, has shrunk a bit in the past 6 weeks with the failure of Silicon Valley Bank, which it survived, but there's been some exodus from USDC as a result of that. DAI is the oddball. It's a crypto-backed stablecoin. It's pegged to the dollar, but its assets are not in dollars. They're mostly in Ether. But it's over-collateralized so that if the value of Ether changes, the number of units that are needed is revised accordingly. So you can take out DAI by borrowing it, and to do that, you have to deposit Ether as a collateral. And when you repay the loan, the quantity of DAI in circulation shrinks again. But there are automatic supply controls that keep it pegged to $1, and it's been successfully pegged to $1. Terra US dollar, which I mentioned earlier, was non-collateralized. Its price was maintained for a while by being purchased through the issue of a separate coin, Luna. And that model turned out to be, unstable. The value of Terra USD declined as the value of Luna declined, and issuing more and more Luna to buy back the Terra only made the value of Luna decline even more. So we won't see that model again. There's a survival of the fittest that has shown us that model is not sustainable. Why do people want stablecoins? Well, their main use is offering fast, convenient payments on crypto exchanges and in DeFi markets. And US dollar Tether dominates crypto exchanges, centralized exchanges at least, the way the US dollar dominates foreign exchange trading. And in this role on crypto exchanges, it has replaced Bitcoin, which before Tether came along was the main pricing unit and payment unit on crypto exchanges. So stablecoins are in that sense a competitor to Bitcoin, and in another sense, of course, they're a complement to Bitcoin because they enable crypto exchanges to work more smoothly. Compared to US dollar banking, they offer instant settlement, lower fees, and compared to Bitcoin as a medium of exchange, they offer a more stable dollar value. But there's a second use. Stablecoins are growing in use for business-to-business payments. USDC is advertising its services in that respect. Tether in Latin America says that 5% of its business is in peer-to-peer payments rather than payments on exchanges. And for these purposes, it's more censorship resistant than going through the banking system. The policy debate over stablecoins is whether they are so much like banks that they should be regulated like banks. So they're like banks in that the stablecoin issuers are issuing spendable liabilities like old-fashioned banknotes or like checking accounts. They're intermediating funds and into interest-bearing assets, the dollar-backed coins. But they're unlike banks in that their capital structure and reserve structure is different. They have a low-risk portfolio, but on the other hand, they have very little capital to absorb losses on their assets, which is okay if the assets are absolutely secure. But as we found out in the Silicon Valley Bank failure, they're not completely secure. So the question is whether stablecoins are run prone. I mean, that's been a fear that's been put out there by their critics. And the answer is no, they're not run prone if they're properly structured. And I think proper structure means having bigger loan loss reserves, having more capital. Should they get deposit insurance? No, of course not. If they get deposit insurance, then they become regulated in the same way that banks are. And we've reduced our financial system to yet more of a monoculture. One product fits everybody instead of having a diversity of products that have different strengths and weaknesses. We need, in order to have a healthy, robust financial system, we need a variety of options for people. So two big warnings, and I'm picking on Lael Brainerd as someone who's actually articulated these, to her credit, has articulated them instead of just hinting. First, she worries about fragmentation in the dollar market, and worries about disintermediate or reducing volume on the Fed's settlement system, and that being associated with a loss of positive network externalities. But I think she's just confused here because network externalities are relevant to the use of a unit of account, not to the use of a payment rail. US dollar stablecoins are offering an alternative payment rail, not a different unit of account. They're denominated in dollars. So by offering a more convenient type of dollars, they're actually helping to spread the use of dollars around the globe. They're enlarging the global US dollar network. Scale economies in the payment system or a clearing and settlement system are something completely different, and there aren't unlimited economies of scale in clearing. The most prominent warning is that these are wildcat institutions, or like the fabled wildcat banks of the 19th century, that they introduce volatility and the risk of run-like behavior, which is how Brainerd characterizes the 19th century in the US. And a similar warning was issued in a working paper by Gorton and Chang, which puts wildcat in the title of the paper, Taming Wildcat Stablecoins. But look, banknotes are not inherently volatile or run prone. If you widen your reading of economic history beyond the antebellum United States, you find out that the US was an outlier in having weak and run prone banks. If you look at Canada or Scotland or dozens of other systems, they had robust, stable systems They weren't characterized by runs or panics on their banknotes. And even in the US, it wasn't every state that had the problem of unstable banknote issuers. It was states that had bad regulations, basically. And I refer you to the literature exploring so-called free banking in the US, so-called because it wasn't unregulated. It was merely freer entry than the system that had preceded it, but work by Hugh Rockoff and Arthur Rolnick and Warren Weber makes this point. So the use of wildcat banking as an analogy is drawing on a myth that wildcat banking was a common experience. In fact, it was very rare. If you want to precisely measure how many wildcat banks there were, you can define them as banks that closed within a year of opening and closed below par, that is imposing losses on note holders. And there were very few such banks. And they were even fewer in other countries. They were practically unknown in other countries. In the US states that had a problem, it was due to state regulations that forced banks to be poorly diversified. It wasn't a problem of being so easy to commit fraud. So again, in Canada, you don't have this problem at all. And I refer you to a piece by George Selgin on the fable of the cats. So historical private currencies were quite popular. They were banknotes and deposits denominated, of course, in the 19th century in gold or silver units, specie units. We've had digital money since modern banking arose around the year 1200. That is, deposit balances are nothing but a string of digits. It doesn't really matter whether they're recorded in pixels on a screen or in ink on a piece of parchment. We've had instant, remote, encrypted deposit transfer since the electric telegraph spread among banks back in the 1870s. In these systems, you don't see volatility. You see par circulation of different brands of banknotes. Banks accepted one another's liabilities at par. And you can see a living model of that today in Scotland or Northern Ireland or Hong Kong. All the notes circulate at par. Their values aren't volatile. And there are some 60 free banking systems, meaning minimally regulated systems around the world that you can look at and see that the fears of wildcat banking are completely overblown. So stable coins are a bit like banknotes in that they are issued competitively and they are bearer claims. They don't bear interest. So the issuers are competing on non-price dimensions, trying to make their use convenient and trying to reassure their customers that they're stable. But unlike banknotes, which everybody used, stablecoins are still a niche product. They're almost entirely used in crypto asset markets. Only now are they starting to be used for peer-to-peer payments. If you look at Tether's documents, they say they're designed with professional investors in mind. But nonetheless, concerns about safety are important. If you look at 19th century banknote issues, they competed on safety by advertising, here's the amount of our capital. And on screen, there are a couple of ads. And you can calculate the capital ratios of these banks. And they're like 15 and 25%. And before deposit insurance, capital ratios of 20% were typical. In some systems like Scotland, banks had unlimited liability, meaning shareholders could be asked to chip in to repay all the debts out of their own personal wealth beyond the extent of their shareholdings. By contrast, US dollar Tether and USDC have very thin capital. From Tether's own self-reporting, theirs is about 1/10 of 1%. USDC, I'm not sure what it is, but you recall that it depegged when it was threatened with losses of its deposits in Silicon Valley Bank, which amounted to about 8% of its assets. So that suggests, they are subject to shocks which would wipe out their capital. And so it seems to me that competition should compel issuers to hold more capital to have better asset disclosures to reassure their customers than we've seen so far. And greater transparency has begun. I think it will continue to develop. But here's the data from Tether's self-report showing that their capital to asset ratio is 11 hundredths of or 12 hundredths of 1%. Another way to put that is that they're leveraged 86 to 1. So you need to be concerned about whether their assets are subject to even small losses, because even small losses would wipe out their capital.